Greetings, market rebels. Welcome to this week's sector situation. I'm Wayne. My partner Ryan's working on our market outlook overview, which should be going out, I think, sooner rather than later today. It is Sunday, May 14th, a little bit in front of, 11:30 here, 11:30 here on the East Coast. Let's get into our disclaimers and then we can move on from there. So here's our trusty general disclaimer. You please take a look at that. And then here is our trusty intellectual property rights notice. Please take a look at that. And then, of course, we've got this week's simple stream. Really, I'll leave this up there because I covered this stuff in macro measure. So I'm sharing the same one, of course, like I typically do. But this is just the general idea really for the week. And I did review this at the start of macro measure if you care to look at that, if you haven't seen it. But what I would say is, honestly, for a change, the story and kind of the more interesting parts of the story are, it seems to be, are with the sectors this week. So that's what is interesting about sector situation. I do still want to wish all those mothers out there a happy Mother's Day. And we're going to have a little shortened program overall in both videos because of logistics and things like that to make sure things get out there. So I won't be doing the long form stuff, which I think is good because it gets, I think, any new viewers to really see where we're coming from. And then, of course, see how critical this week's calendar is and how they move the market around it, how it's orchestrated. And then, of course, to know what your longer term risks are. But we can do that starting again next week, maybe. So on that note, let me stop the share, reposition everything, and then we will get started with the charts. Excuse me, I'm having a little trouble here with allergies, I think. And I think this will get us started. So let's get back to sharing. And I do think that the interesting part of the story is the sectors. And you can see this is our normal grid of 12. We tend to take a quick look at, and I'll go into these a little more deeply and some other things, but right, this just a general take on it. Here's your XLE up in this corner. Let me make sure it's covering the full screen. So here's XLE, and that's kind of looking rough, right? I mean, you're not too far off of the recent low, which is not too far removed from lows a few months back. So that's not acting well. XLF, let's take a look at that. Here's XLF right now. So that's right, not too far off the recent low. And then below there, you wouldn't be too far removed from the March lows. So there's a couple, in my book, very key sectors that are not flashing very well right now. Also, here's your transports over here. These are not flashing very well, right? Now, this obviously, any of this stuff could change and change quickly, depending on what unfolds out there in the world. But this is not something that you're saying, well, I can't wait to go long that right here. I mean, at least I'm not. I need to see certain patterns and corrective activity starting to dissipate, and then see some maybe the chance for a momentum shift. But I'm not seeing that. And so when I look at things like the transports, I look at things like the financials, I look at things like the energy space. Those are three keys for me that keep my eye on, and they're not acting well. And so I think that's where the story is, right? This whole thing about the economy still in good shape. And I think they're using all kinds of gimmicks that they've resorted to in the last several decades. I think those gimmicks in Washington, D.C. are running really strong. I don't think that things are anywhere near as wonderful as they depict. That's always the case, but I think it's really egregious with some of these changes. And that's fine if the politicians in Washington, D.C. are going to spin that. That's par for the course, as I think reprehensible as that is. But when Wall Street sort of gloms onto that and starts running with it when they know better, that's when it's really even worse, right? When Wall Street knows that a lot of these numbers are not legitimate, but they don't want to ever really step out and say in a big way, hey, you got to sell right now and sit on cash, because then people wonder, well, why am I paying you to sit on cash and things like that. So Wall Street doesn't like to get out there and say things like that. typically. Now, some, of course, analysts that are high profile will, but they tend to be the notable exceptions most of the time. Anyway, not looking good, right? XLB, the basic materials, XLI industrials, not looking. What's wonderful about either one of those charts, right? The only thing good we could say about these is they're not overbought. A lot of these things are not overbought the way they were, but right, most of what we've been seeing with this narrow market has been made possible by technology and some communication stocks. And so, but everyone has been noting, right, and I think a lot of you already know this, the leadership situation is really poor. And it's one of the, in terms of market breadth, there's some ways of looking at market breadth anyway, some of the worst kind of readings or measures that are concurrent with the way the market's made a new high in the case of the Qs this week. They actually did make a new recovery high from the October lows. So there's a lot of subsurface things that are not really acting well. And I don't think any of these charts are looking wonderful. I mean, you could clearly with XLK, you could get a breakout more easily, and XLC could get a breakout more easily. But I don't think that really does anything to really solve the bigger problem that we've got. That could be the narrow leadership still working. There is a little bit of a shift here, I think, towards defense and away from discretionary. So you could see that as well, right? Where they came in and bid Thursday and Friday. Let me just magnify that. Thursday and Friday, they bid this up a little bit more, getting more defensive. And then they kind of sold off the discretionary overall on Friday in a bigger way. So interestingly, right, for me at least, that XLRE, the real estate to me, which I think is really whistling past the graveyard versus a lot of these other things that are still whistling past the graveyard in my book, but maybe they're not as egregious. I think there's a lot of risk here potentially, but so far, right, they've been able to mask that with the way that this has behaved and keep this far away from those lows visually at the very least, right? So that's that. But I don't think these things are acting well. Let's get a little bit bigger of a chart to look at a couple of these things a little bit more in depth. And I'll start out and let's take a little bit of a bigger look at some of the key sectors we just talked about. And here's XLF. And if it comes up properly, Thinkorswim's getting funky with me already, not a good sign. But there's your XLF, right? So the financial sector looking challenged to say the least. I would say the bears have really, again, reasserted themselves. And at this point, I think the bears are maybe not fully in control, but the bears are asserting more control over the sector. And to me, like, that is a concerning situation given, right, what we've seen in UOA this year. This has been one bright spot lately in terms of UOA activity. I think there's a lot of, we've had a lot of ideas on the bearish side here in some of the names. We've actually had KRE as a bear too, but right, this is kind of coming back down towards the lows. So you've got to be on guard. Can it hold them? Will it find a way to at least rally a little bit and get away from them for a while? Who knows? But I think there's been a lot of money that's come out of these things. I think there's the potential for a lot more here as well. So, and I don't mean that in a fundamental take. I mean, technically, what I see when I look at the deeper aspects of this, which is really kind of beyond what we do in sector situation, but I think this definitely has a lot more vulnerability. The flip side, of course, is when there's been a lot of money bet in one direction or the other, is that the potential exists, right, for the counter move to be very forceful because there's so many people betting one way. So on the flip side of that, you could think of this as short KRE as a crowded trade at this point, I think. So take it for what it's worth, but the potential's there. Probably, right, with more negative developments, it could really start to trip again. And if that were to happen, you could be significantly lower, right? You could be maybe 20% lower, challenging something maybe that looks like these lows back in the COVID times back here. I think that's somewhere in September of 2020. So yeah, you could be back towards that kind of thing. very easily. And then even beyond that, if we go back a little bit further, I think there's probably even another set of lows that you could end up trading back towards. They're even lower. Yeah, there's the initial COVID waterfall sell-off that year from Feb through late March when you made the low. So that could be the next thing if these 33-ish, I guess you call it 33-ish 50 ballparking it. If you get through there, that's maybe where you're destined to fall to. So that's a lot of vulnerability. That's just 20%. But yeah, I think XLF and KRE not acting well is not a good sign for an economy that we're being told is, being, resilient, and there's some really good signs out there and all this kind of stuff. I think a lot of it is sleight of hand that they're pulling off. And we talked a little bit about that last week. So there's one of your key sectors. Here's your XLE, right? I'm going to say pretty much the same thing. Where is this fully in control of bears? I wouldn't say it's fully in control of the bears, but here's a bigger picture view of it now. And this could be back at lows, right, with a rough week or so. You would be looking at recent lows, but then after that, you could fall back towards your longer term lows pretty quickly. So this doesn't look very good right now. This looks challenged. It looks like the bears are stepping up more and more on the weekly view. If we go look at the daily view, the only good thing we could probably say here is that if this were to plunge and get down to here, it probably would be oversold there once it got there. So I tried to share that a lot, but what I would say on that is, right, there's a reason why we call it support. And usually, right, the first time down, if you do get oversold, you should probably, at the very least, roll aggressively, because usually they were able to put some, much like they did here on these first low, they're able to put a little bit of a bounce together. Then you come down again, and then you've got to see if the retest holds or not. But whenever I get down to a key level where I've seen something support the first time and I'm oversold, I definitely don't wait around for the breakdown even further, right? In other words, I don't not do anything. I definitely do something. And that would, in this, you could either roll, you could trim, you could close, combination, right, of trimming and rolling, whatever. But I would say, look, if you get there, you're probably going to be oversold in the short run. So you should probably, at the very least, roll your contracts lower. That way you'll take some money off the table and reduce your risk. But I mean, it's hard to like that right now, other than it's sort of sitting near the lower Bollinger and it's approaching oversold, but not quite there yet. But another key area that just doesn't look good. So, right, there's the energy situation. If the global situation is starting to improve, as they were trying to sell us on a few months ago, then why is this happening? Now, there's obviously unique situations with respect to the energy market, and really all sectors have their own unique factors. We know that, but overall, as a picture, this just doesn't look good. Speaking of something that doesn't look good, excuse me, XTN. This is another area, right? Transports, where I'm seeing data that doesn't really bode well for transports, and I'm seeing that being ignored for the most part for the past few months. But now, right, this sort of took a turn for the worse. It's below all the SMEs now, and you could be on your way back down here, right, towards another test of these lows. Now, that's not that far away, but remember, this does sort of look like a head and shoulders forming here. So, and I know it's probably one of the most talked about patterns, but historically, it's still an important pattern in the sense that usually you get pretty good movement when these things really do unfold and start to deliver on their so-called projection promise. You can get big moves, but even if you just made it probably down to somewhere where most people would say the neckline is, we'll just ballpark that near 67 without getting into fights with people. You get somewhere near there, that's still a decent drop. But this doesn't look good, right? If you were looking at this the other way, right? If we put a minus sign here in front of XTN, minus XTN, and we flip the chart, invert it, right? I'm looking at that as well. That thing's starting to hold on to its support levels. That, remember, this is pure inverted fantasy, and now looks like it could go, and it's got an inverted head and shoulders, and this thing could start to launch off of these SMAs, but instead, right, because it's holding them, instead, of course, it's breaking down, because that's just the inverted look. But some people really see things more clearly by doing that. So it's every now and then it's worth a quick look if you're really struggling. But I think this is pretty clear. Without that, this doesn't look good. So on bears taking more control of three really critical sectors, that to me is where the story is right now. It's not a done deal, right? It's never fait accompli, but it's pretty rough stuff right now. And the SMH is another one that's, I think, really important. So I'm going to jump over to that. And if we look at SMH, maybe there's still some hope there. I still think the bulls are clinging to a little bit there, but last week's performance was not good, right? They shot it up there on Monday, but the rest of the week it just spent dropping. It spent most of the time just dropping from there. So Monday's high gets put in right there, and then you just fall the rest of the week. And so it had the chance to kind of reclaim that leadership role that it always seems to have during bull phases, that you usually see the semis running, maybe not always the leader, but they're at least running, and they are still struggling. And I think it was there for them. If they wanted to take this breakout and work with it, they could have, but they didn't, right? They really passed on that opportunity. And now, right, it's kind of back in kind of like a muddled situation. The NVIDIA earnings are 10 days from now, I think, roughly speaking. So maybe that could start to shift the tides in semis, because that's such a critical part of those, right? So I think that's the biggest weight. I might be wrong about that. Let me double check that before I kind of make that statement here. Let's go to where am I? Fundamentals will give that to me. I think it should give that to me here. Okay, no, it doesn't give it to me here. All right, fundamentals. Nope. I thought it would give me, maybe I'm in the wrong spot. Yeah, I thought that there was well, the components aren't there, but I'm pretty sure that it would only make sense really that NVIDIA is a big component there. But speaking of NVIDIA, we may as well take a quick look at that. But right, this has been doing great, but right, look at this from 108. Just think about that. Almost right. You're looking at somewhere just shy of a little bit of nearly a 200% return. So in just over half a year, roughly. So there you go. That to me, like this AI thing would really have to light the world on fire again for them to create, big upside surge. But they've done it before, they can do it again. But yeah, other than that, I mean, there's a lot of vulnerability there. Obviously, there's gaps that it left on the way up. That's for starters. But that kind of ascent is just a remarkable ascent. If you look at sort of like a big picture move, you could see big picture view, excuse me. You can see how vertical that's become. And so that's the problem, which I'll try to expand here. And this is what I can't stand about Thinkorswim sometimes. It just doesn't scale the right way. But when you get this kind of a vertical move up, you can see the aftermath of when things get just too vertical, and it could come down very quickly. So this could be vulnerable. Just be careful there. I think bigger picture, I think it's overbought on the weekly. I don't want to get into the weeds and sector situation on individual stocks, but yeah, anyway, that to me has a lot more downside potential because of how much they've jammed it, how vertical it's become, and what's really happening out there. But again, I don't know enough about it fundamentally to say much about it. The AI situation there might be, it might justify what we've seen and keep it in check. But just to note, we'll take a look at some of the futures that we look at week in, week out, right? Just looking at this, and here's your light sweet crude. Again, not on the lows, but that's to me not promising. That doesn't indicate to me that there's robust robust demand and robust economic activity out there worldwide, which goes along with our XLE view, where that just for a change looked very similar. We had really at odds, excuse me, at times. The other ones we typically look at are, excuse me, this is the best I can get for lumber out of Thinkorswim. I think it's running out of time here, so I think they better do something that would give us a little bit more to work with. But another situation where this just keeps sliding, and yet, you know, real estate, home building, that's been resolute. That's stuck pretty strongly to the recovery gains. Let's take a look at that and then we'll come back here briefly. But that's stuck. Like, look where you are, right? We talked maybe about a double top forming. Maybe it still will, but this is certainly out of step with lumber. And again, it sort of perplexes me, but again, I'm really looking at it as just in a basic way, right? Layman's view. I'm certainly not a housing sector expert or lumber futures expert. I'm just looking at it that way, in a simple way. And I just don't, to me, it's out of step, especially where rates and inflation still are. But that's another one, excuse me, that's not lighting the world on fire. So that's a big driver of the US economy. Obviously, I think housing's the biggest driver at this point because it's become an obsession, thanks to, I think, a lot of different factors, but it's sort of become a national obsession. Excuse me. And then copper, we even managed to talk about this somehow, and Pete Najarian chimed in because he and John were talking about it too. But you know, this is, as they say, Dr. Copper not looking all that wonderful right now. Best thing we could say about it is it's short-term oversold, and not really like super oversold, but it's definitely technically short-term oversold. It's outside of the lower Bollinger. Bollinger's narrow here, so not the biggest deal in the world. But again, another kind of, I think, confirmation of the economic data we've been seeing, that they can spin it however they like, but in my mind, it's very manipulated. They're pulling out all stops to rig numbers, and this is not about the administration. They all do it. I mean, every administration tries to do this, and it just, when you're not even, you can come onto a podium and know that you're lying about rig statistics, and not sharing with the people that you're supposedly governing, and you're doing that with their consent, supposedly, right? It's just like, okay, here's the fictitious numbers that we're going to spin to you right in your face. We know it. You should know it. We're going to stick with them anyway. We're not going to really share the reality of the situation with you. I mean, there's bigger problems in the world, but it's always blown my mind that, like, anyone that looks into this stuff will quickly see how bogus so much of it really is. And yet that's what the market trades on, even though I know for a fact that Wall Street knows better, but they don't care. They're going to go with whatever helps their bottom line the most. On a side note, we saw a little bit of a backup there, a little bit of weakening on the second top, lower RSI readings in XAU. So I'm still positioned bullishly there, hoping that it comes off more. But it's a long-term hedge more than anything else, not something that I'm in love with. So at the moment, so I don't mind if it does kind of back up. But just wanted to kind of flash that. We looked at semis. Another one we did look at was this XBI recently, and that was a nice little mover for us. I didn't even really check it out, but it did kind of get up a little bit further and then backed off. So that was maybe one of the very few things that sort of acted more independently over the last month or so that we were able to discuss. So at least we got that. I think I might have mentioned Dollar Tree last week as well, at least in sector situation I did. But this is, I'm sorry, macro measure. I hope it was in sector situation as well. But this was a tough one. And that's the reason I'm bringing this up, is because this is so important. I think if you're new to this game of trading options in the stock market, because you wonder, why is this thing not going or whatnot? Here's your big triangle we talked about. We got out of it. This is one reason we liked it. There's a lot of technical reasons, I think, to like this name. There might even be a lot of fundamental reasons for all I know. But I liked it, and I kind of uncharacteristically did a little bit of very soft table pounding about it, but that's not why I'm bringing it up. The reason I'm bringing it up is that somehow it found a way on Friday to finally deliver on, I think, some of the technical promise that had been flashing. But notice that it struggled. Well, the market struggled overall for the week, right? The SPY, we go back to SPY, it didn't do much, right? It didn't really light the world on fire. There was a lot of sort of nonsense, really, the first 4 days of last week. So it didn't have, there was not very much to work with. Even on Friday, it was a negative day overall. But this is the importance of having the market wind at your back. So Dollar Tree was trying to break out early that day, and we talked about it in the Rebel Pit webinar, but it really wasn't lighting the world on fire. It was up a little bit. We talked about some out of the money calls, like the 157.50s that were expiring that day. They were probably there to be had for about 20 cents if you were so inclined and like to live on the edge, right, with an option that's about to expire. But the good news was that when the market staged that very dubious late day kind of afternoon surge to kind of save the week, which this is what they do quite often. They've been doing a lot of this on Fridays and Thursdays too, but especially Fridays, where they, let's get a 5 minute there. This is what I'm referring to, right? That 2:30, they just burst it up. It spends the entire day practically, right, from the getting sold off. And then these guys come in with their little routine they've got right there and mark it back up. And what that did was keep the SPY above some of the short-term SMAs. There's the 20 there in light blue, kind of kept it right in that ballpark, just barely above it. And the shorter ones it was above those as well. But that's what happened when the spiders finally started to launch around 2:30. That's when Dollar Tree was able to really do much better. And so I just wanted to highlight that because this is first of all, this stock is a really good example of, right, here's 2:30 here's Dollar Tree, there's 2:30, right? So it's able to tack on another $1.50 at that point because of, I think, the market trading higher into the close the way that it did. And that's the important lesson I'm trying to share here in sector situations, sort of a little divergence, but from what we normally do. But I think I mentioned it in both videos last week, so I'm just following up on it here. That was something that you've got to keep in mind that, right, if you can get that market wind at your back, it's a lot easier to trade that way. It's a lot easier overall over the course of time, over many, many trials, to trade with the prevailing winds, right? And if those are up and you can find a sector that's looking pretty solid and you can find a few names in there that are looking pretty solid, it's a lot easier to trade that way. And of course, the converse would be true. If a sector is getting hit and market's getting hit and you can find a couple of names that look vulnerable, that as if they're going to keep getting hit, just a lot easier to trade that way. But I'm trying to think of anything else I can really focus on. I think the story, again, is that the futures are not really showing any kind of promising economic developments at the moment. That's in step with a lot of the economic data we've been seeing. A lot of these sectors that are critical are also saying nothing special or things are worsening. Semis passed on their leadership opportunity. That's really what we were able to get out of the sectors. And overall, things have just gotten a little bit worse overall over the course of last week. And so with all those key sectors flashing, I think problematic technicals, or at least at the very least unimpressive technicals from a bullish perspective at the moment, you've got a situation on your hands there, right? So the market is becoming, I think, a little further out of step with reality when we kind of do this cruise around the markets that we do. All that stuff is really telling us that. And as a key sector, right, is the semis. And like I said, the only thing I can come up with is 10 days you've got NVIDIA, but this isn't acting well at the moment, right? You've fallen below the 50 there is gold. Here's your 20 there in light blue, white is 10 and red is 15. And you could only have the longer term SMAs on the daily waiting for you there. And so this to me is a key sector that's missing, maybe in terms of being really bullish or bearish. But if this starts to roll over and it isn't doing well, a little bit more weakness here, you'll have, I think, four super critical sectors that are not flashing very good technicals. And this is a really key one. And I think that's just a big problem for the market. Could they continue to find a way to rally just using Microsoft, Apple, Google, Amazon, Facebook, and a couple of the others like Berkshire, some of your bigger names? Of course they could, but it's getting some of those are really, really up there. So I don't know how much more they've got in the tank that way. Realistically, I know theoretically they could have a lot more, but realistically speaking, and kind of from my perspective, I don't know if they've got a lot there. So the bulls have a little tiny grasp in some ways still here, but overall, this is another one that definitely shifted towards the bears, more so, and it's very close to shifting dramatically towards the bears. So that's why I would be on guard for it, because if you have this big move lower and you get this bounce, and the bounce is relatively muted, right, where it held most of the decline has not been retraced, and then this package here starts to roll over again, right? Then you start thinking retest potentially, and if that doesn't hold, then you start thinking a full another leg lower maybe. And so I think that would be really not a good development. I'd really be surprised. I'd almost go so as far as to say shocked if the market could shake all three of the other sectors that are key off that we discussed, along with the semis, and still find a way to continue to print new recovery highs. If they do that, it'll be really just an amazing orchestration. A great deft touch will be required to do that. I guess it's possible. I don't want to say it isn't. I just would be very surprised, maybe shocked, if they were able to do that as well. But again, sometimes that's what happens in the market. So there just isn't a lot of other awesome stuff out there to really share. TNX, for example, we've been talking about that in both videos each weekend here and there, but what are we drawing from this, right? Nothing. I mean, at the moment, it's just much like the market. We've got to wait, unfortunately, and we're stuck in a market pattern that is very long, right, in terms of duration, for being sideways in different ways you can look at it. So this is something we haven't seen all that much of this overall, and we're seeing it. It's not as if this is completely uncommon, but this kind of narrow range with low volatility and kind of being where you were months and months and months ago and never advancing, and even in the course of a year, you're just about where you were a year ago, roughly speaking. And that's just, you don't see this kind of thing all that often, but hopefully we're at the end, coming towards the tail end of that right now. But VIX, right? VIX battered. I still think it's an area where, of course, it can go lower, especially if they find a way to rally with the summertime approaching. But VIX to me is still at near a buy point where I would start at least dabbling with my, maybe even like January, February volatility for downside if you're bearish, and start positioning that way with smart strategies, right, that you can live with day in, day out. Even if they mark this market up a little bit or even significantly, you'll still be fine. And then when you decide to get more aggressive, you can. So that's what I'm doing. I did reposition, close some of them out that I had on different places. But keep your eyes, of course, on this as a flashpoint from KRE. And this is where I still have one, but I took the money and ran and repositioned because it kind of got a little further to the downside here than I wanted it to, a little more quickly. So it happened. So if they're giving you money and you can reposition, I thought my inclination is, rather than fight with the situation, that can be take the money and run, right, and then just get something else on that kind of reestablishes what you wanted to have in the first place. So that's my little tidbit on that. But yeah, I still think there's big risk here. I think there's a big bet that this continues to go lower, and I think it's a very much lower. And I think that means that there could be potential for a major squeeze as a result of that. I think there's a lot of short interest. A lot of people are in that trade. So be careful, because those are dual-edged swords, as so many things are in the market. But yeah, we've got to probably end it on that note. I just want to say thanks for tuning in. I hope you did get something out of this week. Little tidbit here or there, maybe, that can help you this week or maybe in the future. I want to wish everyone again a great Mother's Day. I want to wish everyone a great conclusion to their weekend. And at least we had something to talk about in terms of the deterioration of key sectors this week. Maybe that bodes well for going forward. We'll start to see more performance opportunities here and there. So thanks again, and everyone take care.